Thanks very much, Robert. Don Luskin, I want to go to you because you, among all our contributors, have had a very good hand on the pulse of this bull market. From last July, when the Fed was finished tightening rates, there was so much gloom and doom. We had a correction last spring. Since then, it has been a phenomenal performance. I described some of it. First, I want to ask you, are you still in favor of the rally? And second of all, how do you account for this remarkable American and worldwide stock market boom?
Well, I am in favor of it. I think it's going to continue. I think the U.S. market will continue up as earnings continue to rise. Earnings are rising not just in the United States, but everywhere in the world. And it's for all the reasons you talked about in the introduction. It's not only low tax rates, it's deregulation, but it's also something else just as important. It's the interconnectedness of all these free economies. They're not only free inside themselves, they are free to connect with each other, exchange with each other, discover each other's comparative advantage. It's called globalization, it's called free trade, and that is the great secret of why this boom is global in scope and why it will continue.
Don Luskin, the options market by 2 to 1 is betting against the rally.
I've never understood that as a technical indicator. The options market is a zero-sum game. For every put or call that is bought, there is a put or call that is sold. So I don't understand how the option market can be saying anything.
That's true in the stock market, too, though. Every buyer has a seller.
There's a seller. Big deal.
But, wait a second. I want to go back to something much more fundamental here, because I think it relates to the question that you asked Gary. And this brings out an important difference that our audience really ought to understand about the difference between economics on the one hand and investment strategy on the other. Everything that Gary has said about the housing market and the subprime market, it has indeed come true. He's been prophetic about that. I heard him talking about subprime before I'd even heard the expression before. The problem is that's a different thing than investment strategy because it hasn't connected in the real world to a way that an ordinary investor can make any money at. So in other words, it's been right, but it's been wrong. So I remember, Gary, when you and I were on the show together on December 1st, and you said that the 10-year yield was heading to 3%, and I said I'd short you bonds till my head caved in. Well, you were right about subprime, but I was right about the markets. Which would you rather be?
Incidentally,
wait a minute. I didn't say it was going to happen instantly. I said it's going to happen in time, and it still is going to happen in time.
It's Don Luskin. Okay, materials and energy have been big players here, but let's go to telecom. Telecom, like who cares about telecom? Well, guess what? That index is up 41%. Sprint Nextel up 17%. Verizon up 41%. Altel up 27%, to name but a few. What do you make of this, Don? Telecom and tech, two weak sisters, booming in the last 12 months.
Well, telecom and utilities are kind of the junk bonds of the equity world, and they've been doing great just like junk bonds have done. I think another special story about telecom, and here's one where I'm perfectly happy to admit I was wrong. I thought as soon as the Democratic Congress came in, they were going to destroy the telecom industry with so-called net neutrality legislation. They didn't do it. No sooner did they take occupancy in Washington than they gave up on the whole thing. And the sector's rallied tremendously since the Democrats took office. So go figure.
Yeah. Don Luskin, it is interesting. Energy is up 29% in this 12-month holiday of Goldilocks. But you know what? It's 1, 2, 3, 4. It's 5th on the list. It had been cruising for several years, 1st on the stock list. It's fallen. Now, what does that mean?
Well, it's partly a function of your starting point. If you were to start this exercise at the end of the 3rd quarter of last year instead of the 2nd quarter of last year, energy would be number 1. There was a big speculative sell-off in energy that happened right after your starting point. But I got to tell you, there's one element that you're all missing when you talk about the price of oil. You're implicitly talking about the dollar price of oil. Right. So you're asking a joint question of what will happen to oil and what will happen to the dollar. I predict that a year from now, oil will be a lot higher relatively in dollars than it is in euros because our Fed is printing more dollars than their Fed is printing euros.
Uh-oh. Quentin Hardy, do you agree with that last statement?
I'm with the smart guy. Yeah. Dollar's going down, oil goes up.
All right, well, that's a fair point. Don Luskin, you buying America?
Yeah, I am. I'm not crazy about it. I'm always looking for the exit. I'm always looking for something to go wrong. I'm always looking for some crazy Democratic congressman to decide that we've had enough prosperity. But until that happens, all systems are go.
Our next guest, David Ransom, President and Director of Research at H.C. Wainwright & Company Economics, believes that Fed policy is too loose and future inflation is a serious threat. All right, David, welcome to the program. Now,
thank you.
Ben Bernanke's forecast has been pretty good. He's been on the Goldilocks soft landing with contained core inflation. He's been right on track. Where do you think Mr. Bernanke is wrong?
I don't think we have contained inflation. The core index is no good as a measure of inflation it's extremely lagged. It's a very long lagging indicator. We do have a soft landing, however.
Tell me, what's the indicator that you use to predict future inflation?
As you said, it's gold along with other precious metals.
Don Luskin, what do you make of David Ransom's analysis?
Well, Larry, I think, as you know, I am a gold bug myself. I think that gold is not only a great indicator of inflation, but practically a definition of inflation. I'd take the gold price over the CPI or the PCE any day of the week. I think where David and I differ, and I know this because we've had these conversations privately, is what you do about it. I believe the Fed is still powerful. I think the Fed has printed too much money. I think that's why we're seeing a high oil price, a high gold price, other classic symptoms of inflation that haven't fully yet showed up in consumer prices. So it's simple to me. The Fed just has to withdraw some of that liquidity. But I think David doesn't believe that the Fed is very powerful here. I think David believes that some institution other than the Fed is responsible for what he and I are both seeing in gold. So may I turn a question around and ask David to explain what does he think Bernanke or somebody else ought to do about this?
Go ahead, David. Good question.
Yeah, I would like to see the interest rate set by market forces and take Ben Bernanke and all of the central banks out of the picture completely. I'm a libertarian.
All right,
I'm into that.
I want to just put I'm an ex-gold bug. I'm still a gold watcher. All I'm going to say is it doesn't seem to have worked as a forecaster. Some cycles are different than others. Why that is,
Larry,
I don't know. It just doesn't seem to have worked.
One of these days it's going to get bad. You know, what
Don
are you saying,
Luskin, I'm going to put on the board the volatility of gold, the implied volatility of gold.
All right.
These are from the gold options. And what you see is, you know, it puffed up a little bit. Here's this gold implied volatility. It did rise a bit in 2005, but it's come way down since then, and it had been down in the prior 3 years. Some people, Don, think the volatility of gold is more important as an inflation indicator than the actual price level. You have a thought on that?
Yeah, I do. I think there's some wisdom in that, but you have to be careful with it. There is the market's estimate of future inflation, and then there's the market's estimate of its own uncertainty about its own estimate.
Right.
And there are times when things are happening in the policy world or the political world that cause there to be a great deal of uncertainty about inflation. So the mean of all that uncertainty might be high, it might be low, but the uncertainty itself can cause a high gold price.
Are you buying gold, metals, mining, materials, and commodities right now?
I have to say I am. This is an unofficial personal prediction, not my company's prediction, my personal prediction. I say gold 1,000.
Wow.